just quickly explained, not that much that I said and that you missed, just introduce the topic, which is pros and cons of the momentum indicator, and we'll find out which ones are good, maybe not so good, and what we can do with them. The fact that this is intended for a global audience, take a look at admiralmarketsglobal.com to see if it's suitable for you, and the fact that there is high risk involved in trading in foreign exchange and other financial markets. Seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only, and by continuing watching this webinar, you agree with this disclaimer. So I hope that you can hear me now properly, just a sound check, I guess, quickly, as I started off with a wrong note with my mute button. Caitlin says it's all good. Great. So this is presented to you by Admiral Markets. Take a look at the website after the webinar, preferably admiralmarkets.com. You will find a lot of good info, a lot of education, analysis, but also information about how you can trade on a demo or real, and take a look if that's something for you. I definitely recommend to check out the website and see if it's something for you. All right? We're going to talk today in this webinar about momentum indicators, pros and cons, which I consider great indicators, and then Nennet will share his light halfway, approximately, what he thinks are good indicators, etc. I'll be talking about catching momentum and something that really has nothing to do with price action or any indicators or tools, and that's the fifth point, which is time factor. For those that join my live webinar occasionally, you probably have heard me mention it before, but for those that are joining maybe for one of the first times, I'm going to talk about time factor. I mean basically the fact that we count how much time a certain movement has elapsed, has taken, and I try to derive information just from the length of a certain pattern, a certain price movement. Instead of looking at candles or a moving average, I don't look at price-oriented stuff, but it's time-related. Alrighty. Just a quick, a few quick slides basically about the pros and cons. It's something that many of us already probably have seen somewhere, so I don't want to elaborate here too long. But definitely, momentum indicator is good for identifying the flow of where price is heading to. We obviously can get a good indication about that. Momentum is a one-directional movement, and that's what I call flow. So basically, price pushing into almost continuously into one direction, and a moving average, for instance, could be right behind it. Well, if it has an angle like that, it will identify a good angle like that will certainly show us what the flow of the market is. We are able to measure its pace more properly and have an idea about how fast price is moving, right? Not only that there's a momentum, but that there is something quickly going on. Not only that there is momentum, but how fast is it moving, basically. And the advantage is that it's great for open TPs in the sense that once you enter the market and there's momentum going on, you can just trail stop it, for instance, because all these candles are going your way, and you can most of the time just trail stop the candle low or fractals, and you can get multiples of R2R because you're allowing the trade to become a home run or at least a big winner, and you're not cutting the winner short. So those are our three advantages. We know the flow, we know how much the flow is, and we can get more mileage out of the trade. For instance, I was talking here about the euro dollar. That was on Tuesday in the live trading room. And for those that join me know that I was talking about the fact that this could accelerate to the upside. That this, from a wave perspective, because it was a wave webinar, that this could be a wave 1-2, 1-2, and then if it is such an account, it could really accelerate for a major wave 3. And that's what happened indeed. And this was a tremendous momentum, right? So the advantage of that momentum is the fact that it's great for open TPs. We can leave it open and decide later on what kind of target level could be optimal. All right, other advantages is letting your winners run. It's kind of the same actually, but quick trade in terms of how long you're in a trade. I mean, if you're in a trade for 2 days, 3 days, whereas you are trading a 50-minute chart, that could be quite long and annoying. So if you're in and out quickly, then that is pleasant with the psychology, for instance. Obviously, if you took it in the long here, like, or I took it here, or someone took it here maybe, as I was showing on Tuesday, what kind of trades, long trades I would be taking on the euro, then it's easier to stay in a move like that for most people than to stay in something like this for very long. This certainly reduces the time to stay in a trade. This still might be too long for some, but that's also a question of experience and getting more experience and just more knowledge about the market. Then that just takes some time. Less nervousness is just connected actually to the fact that there is a quick trade, so that's always good. Let's take a look at pound odd. I talked about the pound odd short on Tuesday too. And there was this break right here. And I said, look for price to retrace and continue. Right? So that indeed fell nicely. I caught a piece of that action. So when we go to this trade on a 50-minute chart, or 5-minute chart even, we had the break, pullback, and continue. I took the counter trend break of this trend line, entered here and exited somewhere here. I went for the trade close for 50 pips. Not a lot compared to the entire fall that it made, because that was about 250. But what was the advantage of grabbing 50 pips there was the fact that I grabbed it quickly. So the time factor helps the nervousness, right? Helps us be more confident about catching a decent amount. Whereas if I would have aimed for a larger part, I would have had to wait through a lot more price action. And that has the disadvantage of nervousness and maybe getting out of the trade too early. There's less nervousness if the trade is shorter. All right. Disadvantages, well, they're lagging indicators often. Price corrects quite often, maybe 80%. So you don't see these momentum outbursts all too often. You see more price kind of just like going sideways like that. So if we try to trade momentum, then it could take a while before that happens. You'll have maybe more losses, and the winners will have to be bigger, which is, from a psychological point, not as easy. Traders almost intuitively try to grab some profit, and it's difficult to accept more losses than wins, although it could be equally profitable. So those would be disadvantages. Cutting winners short is typically a lot easier than cutting losses short or letting winners run. It's just pretty tough. On paper, maybe okay, but in reality, it's quite difficult. I mean, honestly, a trade like this, your dollar, how many, or even pound today, how many people can really stay in 400, 200 pips? It's not easy. Certain areas, I think that's definitely possible, good setups there, but it's not easy to really implement that and to stay in that trade. So it's tough from a psychological point of view. Disadvantage, if you're waiting for momentum, is because there are maybe not that many trades, or less trades than corrective trades. It gets maybe boring. You're looking at the screen often and long, and you're waiting for that moment. And if you walk away for a second, you might miss that moment. So that sometimes, you're waiting for some certain confirmation on price. You're waiting for something on the chart, and it doesn't happen. You're looking at the screen. You're looking at the screen. You're looking at the screen. Looking at the screen, and you think, okay, now I'm going to check social media. 10 minutes later you look and you miss the moment. That could happen, and that's annoying. Disadvantage is perhaps also the fact that we're waiting for we're basically waiting for a more confirmation type of trades. All right. Great indicators for this, in my opinion, EMAs and the awesome oscillator. EMAs, because let's grab a chart. Or let me grab a simpler chart. You see this red band here. It should be a 21 or it's a 34 EMA in this case. This is great for momentum. As long as price stays below a 21 EMA or 34 EMA like that, you're going to be in a position where price is in a good momentum, especially if the angle is pointed with a nice angle, basically, right? Like this, for instance, here, and even this part, and this part. So a momentum indicator like that will give us a lot of information whether there is a good speed and a good power. What we want to avoid are more areas like this, when it's flat, for instance, right? Not necessarily untradeable, but it's relatively flat. Actually, this euro dollar doesn't have many flat zones. This one, finally, a good example as well. The awesome oscillator is based on, indeed, moving averages as well, with the difference that this is represented on the chart and this is represented in histogram bars. The reason why I still like both is the fact that this is support or resistance and interacts with price and shows an angle. The reason why I like this is because we have a clear middle line. We have clear bars going either up or down. And we have clear information about divergence or not. So there is a lot of advantage, in my opinion, to have both. I trade often with both, and that's kind of my standard way of looking at the market, with these moving averages and with this oscillator. And you can, I think, read a lot about price action just by looking at this. And you can say that this was indeed a very choppy zone, right? The moving averages are more or less flat, especially if you add some other moving averages. Let's do that. You can see here all these moving averages intertwined. Basically, this is an intermediate moving average, 136. When the 21 and the 136 are basically mixing with each other, when the 21 is let's say touching the 136, that's an indication that there's no momentum. When they're away from each other, there will be a trend or momentum. And you can see here where I have 3 sets of bands, of moving average bands, instead of only the 34 EMA that we saw. The chart becomes a bit more busier. It becomes busier. It becomes more complicated, perhaps. But so it depends. Maybe for you, 34 is enough, or 21 is enough. I don't always look at this. Sometimes I do. To me, 34 is also enough, but sometimes I throw on this template just to see where the other moving averages are and get a bit more information on that. But you can see that by adding those higher information, perhaps about if there is a slowdown in momentum. Now, if you have questions about the EMAs or oscillator, let me know. Basically, momentum on the oscillator, you would have a very strong push here. This is a very strong bearish push here. How you can measure strong is really, I don't have any number in mind. I just look relatively. I look at how deep this has gone or how far this has risen. That's all. Especially if there's no divergence, like here, for instance, then I expect follow through. If there is divergence, I'm a bit more cautious, but if it's single, it could still be fine, especially on the lower time frame, like 1 hour or lower. If it's double divergence, then a bit more cautious, certainly, because that's when we can get into a danger zone. Higher time frame, I'm already cautious with a single divergence, especially, of course, if multiple time frames are showing divergence, it's something to be cautious of. You can see here, clear momentum spike, and we get the follow through. Often enough, it says a lot about that, all right? Sometimes, obviously, this is maybe a good example where you have a strong push here, but you don't get much follow through. Actually, the trend changes. So obviously, it is good to look at support and resistance, at potential tops and bottoms that could change the direction. All right. That's regarding moving the oscillator, just very simply looking at the power and divergence, okay? And that measuring momentum. The EMAs, I look at angle, I look at the sets of moving averages so that they're not intertwined or flat, or kind of like mingling with each other. I look if price has, from a price action point of view, made a pretty nice gap here with the moving averages, a gap here away. When you move away from the moving averages, you often get a hook back. So it's good to, for instance, if this breakout was missed, then to look for a move back actually to that same 34 EMA, or even put a fib on and look for a move to that fib. Let me see if I can find a recent example. Here even, there's a counter trend one, right? And I know that Yen is with us in this webinar and made some nice pips with this long right in here, based on the fact that this was perhaps going to be a zigzag. That was the analysis, a zigzag correction based off the 61.8 fib, what I was discussing on Wednesday in the live strategy session. So great job, Jen, on that. Awesome trading. But that's an example where price moves away from the 34 and gets a gap. So those things are good. Look for the gaps and hook back to the moving averages. Often when you get a gap, the moving averages will have a good angle. Let me think if I missed anything on these two. I want to elaborate on these things, on these two, because these are my personal favorites. Just thinking for a second if I missed anything. Yeah, one more thing, actually. I also look at where's the fractal in comparison, not only price action, but where's the fractal in comparison to the band. That's something that I actually don't discuss that often in the live webinars, but it's an interesting thing to look at. If the fractal is far away from the band, it's not so an important fractal. But if the fractal is at the band, it's often a pretty important level. And if it does post a fractal, it's often a turning spot. So something to look into. The first fractal really below or going through the band, it doesn't have to be right away the total reversal, but it is kind of first warning. And you can see, indeed, that this one poked through, and after that it did retrace deeper. All right, if I think about something else, then I'll still let you know, but those are main things I look at. Now, there are other great indicators, but I don't use them. Ichimoku is I would say, a very good one as well, but the thing is that I already use EMAs. So in that regard, there's no, in my opinion, reason to keep these two, both of these on the chart. It would just make things very crowded. Many traders use Bollinger Bands. I can see that. I can see their value. Parabolic, I know traders that use it. ADX, ATR, Alligator. Alligator I've also sometimes used. But although these are great tools and indicators, I don't use them as a standard. I sometimes add them though occasionally if I'm just curious about a certain value, but it's not like my standard view. I think that patterns are very important with catching momentum. Looking at previous impulse and correction patterns, market is always making that impulse and then a correction and then an impulse. So if you look at impulse and correction, you will be able to, I think, get a better idea about where the momentum could go. Moving averages will help, right? If we have moving averages like that, it would look something like that. And as I said, the gap here between price and the moving average indicating that momentum. And when that happens, the moving averages tend to be support or resistance. If there's no gap or small gap, then the moving averages are not so considered to be support or resistance. In fact, if moving averages are like this, price tends to do actually more spiky around it. So looking at impulse and correction is good, right? Here we can see clear bearish price action, bearish momentum, strong candles going to the downside, corrective candles going to the side. So we see a follow through end of May. And we see a big follow through, all the time respecting that 34 EMA until finally that one moment on Thursday where we got a push above it, a hook back to it, and we use it as support on the pound. That was the first zigzag. That was the first breakout. Then we got another hook back and support. The euro dollar, same thing. Down momentum, correction, continuation, and then here we see kind of a build. We did dip below it again, but ultimately we started to recross it here. That is something also to keep an eye on. A recross like this, for instance. Here you have the first cross, or the first two crosses perhaps, where price goes the opposite direction above the 21 EMA instead of below it. So we're changing gears. And this is the second time. When this happens second time, it's often stronger and more important because of this motion and this particular pattern. This particular first break is always a bit more vulnerable. So looking at impulse and correction will help, I think. Impulse candles are often bigger, with closes near the low, with candles in one direction. Correction candles are small, non-directional. If you start to like that, you might even want to look into wave analysis, because all wave analysis does is glue these momentum and corrections to each other and say, okay, the previous one was impulse, then I had a correction, then there was another correction, then there was an impulse, so the next one will probably be a bearish correction. That is what wave analysis does. It looks at the chart like a jigsaw puzzle and says what's probably going to be the next piece of that puzzle. What it then does is label those pieces of the puzzle with numbers and letters. And it has rules and guidelines, so in some cases you can get very precise with those letters and numbers. But if I think you take it as a guideline and not count it too strictly, perhaps, and just primarily look at the impulse and correction, I think it's already a great valuable tool. Chart patterns are great. Bull flags, bear flags. If you don't know what chart patterns are, I'm running a bit out of time, so then I would encourage you to take perhaps a look at other webinars that I have had where we take a look at chart patterns, but a classical one is a triangle like that, for instance, impulse triangle continuation. Look at candlesticks to gauge the momentum where the closes are. All right. Now, so patterns, I think, will help with identifying momentum and catching it. Exiting that momentum is important to gain the most profit. We can use trail stops on the candles or fractals, or look for divergence on a lower time frame, for instance, to exit early, or a higher time frame to exit, to give the trade more space. Let's take a look at the euro dollar here, right? Where I was looking at a break here, and then a potential bounce. Unfortunately, I had the trail stop myself a bit too tight, but I did say these fibs are potential bounces and a bounce here. So when you look at this first move up, that was momentum. So basically, if I would have actually followed my own rule probably and only trail stop strong bars and not weak bars like these, what I did actually, then I would have stayed in that trade for a follow through and I would have caught more of that momentum. One of the reasons why I still was a bit more aggressive in moving the stop was this resistance spot. But ultimately, it did turn out to be a wave 3, 4, 5. Next time, perhaps we'll just keep the trail below the 38.2 or the 50 fib. But what you can see here, my point anyhow, is the fact that there was no divergence indeed here. Strong oscillator, strong momentum, and you get the follow through. And basically, when you get divergence, that's maybe where you want to be more cautious on average, unless indeed there's reason to be cautious because there's a strong resistance and multiple resistances, whatever, news events, of course, etc. Last but not least, got a couple of minutes left and then also some questions I dive into with you. Time factor. That too, unfortunately, there's quite little time for that. Would require a bit more time to, I think, explain it. But ultimately, what it says is if 5 to 6 candles don't break the high or the low, when we have an upside momentum, for instance, the highs, or if we have a downside momentum, the lows, if 5 to 6 candles do not break the high in this upside, we're pushing, 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 and then 5 to 6 candles don't break it, then this upside momentum is over, and we are now in a correction. This does not necessarily mean that we cannot resume the upside after that. It could. But this swing high, swing low, I consider finished. That helps me with trade management because I know that as long as it keeps pushing with a higher high, I don't have to be all too worried. All right. It helps me with finding exits sometimes because I know that as soon as it has 5 to 6 candles not breaking the high, that it could be a good moment to exit. Not always, but if I'm expecting, let's say, an ABC zigzag, and I'm expecting a turnaround here, then that would probably be the optimal exit when 5 to 6 candles do not break. It could also happen that I'm expecting a zigzag and I'm expecting a bounce here. In that case, if 5 to 6 candles do not break the lows, then that could be a good moment that we could expect the zigzag upside to continue here in this case. Giving some examples, let me go to a blank chart. Your dollar was a clear one here. 5 to 6 candles not breaking this bottom. This momentum was over. Here too, 5 to 6 candles not breaking the momentum. This momentum was over. But despite the fact that the momentum was over, we still got a new break and a new downside. It doesn't prohibit that. Here we had 5 to 6 candles not breaking it, and we're getting that bigger correction. If you have any questions, just send me an email about this if this is unclear, as I will just take a look at some questions from you, and then I'll pass it over to Nenad. There's my email, and let me take a look at the questions. What value of pips would I use for trail stops? Well, with 4 hour, I tend to use 20 to 25 pips. With lower time frames, depends, a 50-minute chart, anywhere between 3 and 7. A 1 hour chart, around 10, 15. So it does become more as I move up time frames. It also depends whether I want to be a bit tighter or looser. If at the beginning of a trade, I'll definitely give it a bit more space than if for instance, here the trade just started. I'll be more patient than if the trade is up in here already after surviving, let's say, a pullback, two pullbacks already. Then at first, sometimes I would even trail stop on a 4-hour chart, but if I see price already up into a plus 400 zone, I might even zoom into the 50-minute chart, and this is if I'm lucky enough, let me say it this way, and I live through, in this case I didn't survive this pullback, but if I would have survived this pullback and this one, and see a second break of this top, then I know that, with double divergence there is a chance of a retracement. I might even do it extremely tight all of a sudden and go from a 4-hour chart to a 50-minute chart just to lock in as much as possible, or even close it. But that's a different story. But the trail stop, those are general guidelines for trail stops, okay? Have you ever backtested just trading price above moving averages? Maybe, I don't remember. A long time ago, I did do a study on moving average, but I mean, talking about years and years ago, and I would not know it by heart anymore. But it showed basically, if you're looking for breakouts, you're just looking at more losses and bigger wins. So, you have to be ready for letting the winners run and trying to really get capitalize on that. Or you need to take pullbacks, and look for the fib pullbacks, and then you'll have a bit better rate on bounces, I think. Regarding divergence, what I basically look for is price to go back to the zero line before I compare it. So when I compare this and this top, it's okay because the oscillator has gone back to the zero line in the meantime. If it has not gone back to the zero line in the meantime, like this one and this one, I don't consider that a 4-hour divergence. It could be, though, if we look into a lower time frame, a 1-hour divergence between here and here. Obviously, there is divergence between the blue dots, but not between the green dots. That green dot could be on a lower time frame. Yep, Ichimoku is definitely good. Let's see, pin bar on the 4-hour chart. You're on a 4-hour chart, pin bar? I'm not sure which one you mean. Perhaps this one here? I don't. Oh, okay, no problem. Do you think the correction cable's downside is over? The downward momentum looks over. What do you think? Yeah, I'm not sure here. Well, definitely when the London session was over, we could expect a consolidation like that. But I trail stopped it tighter here than my own rules because of the resistance that was close by. Pound dollar at this moment, I think we're still in the bouncing area. I still personally think that at this moment, we could see a push up to 155, which is the target, the main target for the moment. It's minus 61.8, in my opinion, unless price really breaks below, well, for the moment, the 4-hour bottom at 152.50, really. But it could become this bottom. If this candle closes, then this is a fractal at 153. Otherwise, I would still expect this follow-through correction to 155 today or tomorrow. If not by today or tomorrow, next week it's a new ball game, and I would like to look at the charts again. Really, my opinion. Alrighty, that's it. I'm going to pass it over to euro dollar tomorrow. Well, I don't know. I would be cautious with the euro dollar. It's reached really a pretty high level here, and resistance top pretty close by. Pound, I think, has more space. Alrighty, let me pass it over to Ned.
Thanks, Chris. Great presentation as always. And now we can continue with our webinar today. So we will talk about momentum, RSI, MACD momentum, pros and cons of momentum indicators. But there is definitely more pros than cons. And we will see again what I mean by pros, because today if you traded Australian dollar, you could have made 100 pips just by using standard Camarilla MACD definition of momentum pullback and finding POCs close to important, in this case, resistance. Okay, so today there will be a good example for today's webinar of our Australian dollar setup and trade. So what is momentum? Momentum is a measure of price and change of velocity, which is calculated as the difference between the current bar price and the price a selected number of bars ago. Okay. The thing is that momentum in Forex definitely speaks the truth. So we always say price frequently lies because there are a lot of manipulations sometimes happening, but we can go through these manipulations because momentum speaks the truth. Okay, when you align momentum, when you align trend, momentum retracement, you will get a direction. Okay, many professional traders trade momentum rather than price, and many traders trade price along with momentum. What does it mean? Basically is that many professional traders will definitely trade breakouts, will definitely trade pullbacks, not just the price, okay? Because the loss of momentum, we call it retracement, okay? Once retracement has been done, price gets into trend tracks with additional momentum gauge, okay? Momentum gives us the force behind the move and pushes the price into desired direction, okay? That is always happening when the price is in a retracement mode. We wait for the retracement to hit our price zone, we pull the trigger and wait for another additional push of momentum into the trend direction. Okay? Momentum can be described as the level of market sentiment behind any given market move and the ongoing battle between bulls and bears to influence the direction of the price. Markets frequently hit areas of support and resistance, okay? And those indicators which you use, momentum indicators, will help you to define whether the market will be likely to respond to these levels. And finally, momentum measures the speed of price change. The faster the price increase, the greater the increase in momentum. The faster the price decrease, the larger the decrease in momentum. Okay? So we can use momentum indicators for following methods. Overbought, oversold conditions, which I don't particularly use, but there are some systems and methods which do use it. Chart pattern momentum breakouts. Trend following and retracement. I'm a big fan, as you already know, of retracements and trend following, and I use momentum to give me an exact entry, okay, to give me an exact entry where I want to press the trigger. And divergence, which is the earliest sign of a possible reversal or retracement in a market, okay? How to measure momentum? Okay, for overbought and oversold conditions and charting breakouts, we usually use RSI indicator, relative strength indicator index, usually tops above 80 and bottoms below 30. It usually forms these tops and bottoms before the underlying price chart, okay? So usually RSI will plot these levels, and after it hits 70 or above 70 or 30 or below 30, the price will react. Okay, this is how it usually goes. We can, as you already know, we can plot trend lines on RSI because RSI is a leading indicator. It mirrors the price action. When you put trend line, you can watch for trend line breaks. You can see it here in these chart examples. This is overbought, oversold condition, and this is also trend line breaks. Okay, so that is how RSI indicator is functioning. Also, the thing is with RSI, It's a good one, but the primary advantage of using RSI is that actually you can plot these trend lines and watch for trend line breaks by using it as a price action mirror. Okay? Not just for overbought, oversold. How to measure momentum? Basically, we can identify it, or by using it, important support and resistance levels. If we pair important support resistance levels with RSI indicator, okay, you will see this example. Okay, it can identify momentum loss and when not to take breakout trades or exit the position. If you see that the price is really pushing to the upside, but this is a critical resistance, you can see that RSI is overbought. You will not be trading this breakout, and nor you will be taking this breakout. Okay, so once you see that the price is going to hit the resistance and you think that you should buy into resistance, just check your RSI indicator. If you see that RSI is very close to 70, do not take the trade. It can save you from making bad trade. And 21 is a good one. When I was using RSI, I used 21. Okay, but I think also that 9 is also okay. It depends from a system to a system. Okay, usually RSI is used in systems, not in sort of naked trading. My favorite, as you already know, is MACD. Now I will teach you how to measure momentum with MACD indicator, because MACD indicator gives you valuable information about momentum and retracement. Okay, MACD is also the most used indicator for divergence. Now we will not talk about divergence. We will talk about how to spot momentum within the trend context by using MACD indicator. Okay, MACD is frequently used to identify momentum. It's one of the most popular momentum indicators. It can also, because it can identify momentum, it can also identify retracement. MACD on charts can give us a valuable information about momentum and retracement. Okay, and we will use top-down analysis on MACD to measure the momentum. For that kind, we need MACD two-line. Okay, this is MACD two-line indicator. I'm sure that most of you have it, so you don't, and you should not be using MT4 MACD indicator. This is a custom indicator, MACD two-line. Okay, so when blue MACD crosses above zero line, here, this is zero line, that is a bullish momentum. So blue line crossing above zero line, it is a bullish momentum. Okay, when blue MACD crosses below zero line, it is a bearish momentum. Now, how can we know trend and momentum when trend and momentum are aligned? Very simply, when blue and red are above zero line, then we have both trend and momentum. So if both blue and red are above zero line, we say that we have both trend and momentum. When blue and red are below zero line, we have both bearish trend and momentum. Okay. Now, blue crosses red while still above zero line. That means that we are going in retracement mode. So we are still in the trend, but we are having retracement. What is a trend? A series of thrusts and pullbacks. This is a trend. This part is called retracement. MACD can very clearly identify retracement in uptrend or downtrend. When blue is above red and both are above zero line, there is both trend and momentum. We have a momentum loss when blue crosses red while both of them are still above zero line. So there is a loss of momentum. But that does not necessarily mean that the price will reverse. It just means that we should be ready for additional buying, where in my example I'm looking for POC, what means point of confluence, and exactly when price hits POC zone, I pull the trigger and I'm looking for a buy or a sell trade. This is retracement in downtrend. Both of blue and red are below zero line, but blue crosses red while still below zero line. Okay, so this is retracement in downtrend. Okay. Now, trend retracement top-down analysis sequence for intraday trading usually goes 1 hour to 15 minutes, 4 hour to 1 hour. Eventually, we can roll up to 4 time frames until we spot a retracement. 4 hour, 1 hour, 15, 5. 1 hour, 15, 5, 1. We do not watch any momentum on 30-minute time frame. 30-minute time frame, I'm almost never using it. Okay, so 4 hour, 1 hour, 15, 5, 1 hour, 15, 5, 1. This is 4 hour. I have plotted a vertical red line, so you will be seeing how you can easily use MACD to spot momentum and trend. So this is 4 hour. This is trend on 4 hour and momentum. Okay, so you don't want to buy here, because you have both trend and momentum. What did we say? We need to have a loss of momentum, so-called retracement, to buy in a trend. Okay, 1 hour also has both trend and momentum. Look, 15 minutes has a loss of momentum. So 15-minute chart will be used for entry. When you want to make an entry, you will be using MACD 15 minutes in this example. Okay, and once you make you want to pull the trigger, you just need to check if 1 hour and 4 hour both have trend and momentum. That means that you have spotted a proper retracement, loss of momentum within the trend context. So you can freely pull the trigger, because 15 minutes is giving you an entry, while 1 hour and 4 hour will give you the trend. Okay, I hope that this is clear. Okay, 1 hour, for example, is having both trend and momentum. Look, 15 minute is having loss of momentum. So you pull the trigger on 15-minute time frame. This is a general idea when I was making Camarilla MACD course, and very frequently we can use MACD to spot momentum when price is getting close to POC, or so-called points of confluence. So pros for using momentum indicators are, they will give you, those indicators will give you direction of the price. You can spot divergence almost instantly after the candle close. It is possible to clearly identify when pairs are overbought and oversold. It's an early indication of reversal, because it can give you overbought and oversold levels. And very big advantage, multiple time frame analysis, grabbing the retracement. Okay, so this is trend retracement reversal pattern. First we have a trend. You see, this is a trend. Then we have retracement. Then we have another trend push, then retracement, then trend push, retracement. This is not a retracement, this is reversal. Okay, so there is a standard pattern which we use. It's called trend retracement, trend reversal. And believe me, as long as we are in a trend mode, we are either buying into dips or selling into rallies. Once we hit reversal levels, which you can occasionally read in mine and Chris analysis, then when you have a reversal of uptrend, then you should be ready to sell into rallies, not buy into dips. Okay. Live Australian dollar chart, guys. Today's trade. If you remember the analysis from today, okay. This was the analysis. This was the time of the analysis. At the time while I was doing the analysis, the price was at 77.30. It was posted then. Price hit both POC1 and POC2 and perfectly reversed to hit our targets. You could have made 100 pips with this trade. Camarilla MACD setup. And you can see it here. This was the analysis which I did. And you can read it, of course, here if you haven't already. But the thing is, that is what momentum suggested. 4 hour at that time was still in a big downtrend. Huge downtrend. And when I open up 1 hour chart, I could definitely see that we are still in downtrend, but the price was trying to hit POC. And POC was hit perfectly. 50 retracement L3, price went here, look, and rejected. Many people probably thought that it is time to buy Australian dollar. No, it was time to sell. And if you sold it from POC, 100 pips. Okay. So that is why you should definitely understand the suggested pattern which I have explained here. And that is always, guys, the same. Trend, retracement, trend. Retracement, trend. Retracement, trend. Until we analyze that there is reversal. Retracement is not reversal, because retracement is only observed as a part of a trend. Reversal is when we switch from buying into dips to selling into rallies. Okay. Now, cons for using this, I don't know many cons, but for example, if you use overbought and oversold, you know that price can stay trapped in overbought oversold condition for too long. Trend might turn to reversal instead of retracement. Okay, so instead of retracement, for example here, it can just go down and make reversal, but it doesn't happen always. It happens when trend is too strong, and definitely we need to see a trend end, and basically then we have reversal. But we need to analyze the chart before we know that it's a reversal time. Also, there are no too many chances to enter the trades. So this is not for impatient. If you go with standard trend retracement patterns and you are doing it on a 1 hour chart, then you need to wait because price needs to pull back. So if you were patient enough, as you saw, you could have made 100 pips today. If you were impatient, then probably maybe you were stopped out, maybe you didn't take trades, but patience is always required. And also, we can miss some movements if there is no retracement. For example, our last session recap, dollar yen was great and it went in analyzed direction, but the thing is we didn't see pullback. So we can miss movement if there is direct jump or direct fall. Usually when price is going up, it should reverse, but sometimes, guys, it doesn't make any, it should retrace, but sometimes it doesn't retrace, it just keeps going up. In that case, you can miss some movement, but what then? We have 20 pairs to trade. We are not sticking just to euro dollar or Australian dollar. There are other pairs which can be traded. Okay. So this is everything I also had for you today. So if you have any questions, feel free to ask me. Yet, guys, if you don't have any questions, of course, be sure to follow us on Twitter. Okay, there will be additional webinars. We'll be scheduling July webinars also very soon. This is a weekly recap. Do not forget to sign. Trendline trading with Chris, and we will have also soon, very soon, scheduled webinars for July. So if anything is not clear in this presentation, I can explain you, but I don't know which system or method you're using, but it's very important, guys, to know about price action, because if you cannot differentiate between retracement and reversal, chances are that you will be losing money. Okay, so if you know that we are in uptrend, then unless you're very determined to go in a counter trend trade, it's always the better option to buy into dips than it's to sell into rallies. It's more secure, believe me. Okay, so always try to spot momentum and try to spot a momentum loss, because momentum loss in the context of trend is actually retracement. Okay, and if you use overbought and oversold, for example on RSI, it can definitely save you from buying into resistance and selling into support. So guys, this is everything we had. I don't see any questions, so then we can assume everything is clear. Okay, I hope that you all received Heiken-Eshi template, which I presented yesterday, and that you were making and can be making money with Chris and with me and this analysis, because as I always say, we are here to help you. So guys, we will be here with you next week. Expect NFP tomorrow. NFP will be very volatile. Okay, NFP will be very volatile, and I advise only small trades during first 3 hours of London session. Then do not do anything until NFP is done. Okay, there will be some big movements tomorrow. Okay, so thank you for listening. I wish you great rest of the week, and we will see you soon. Cheers, guys, and as always, trade safe.